Welcome to another edition of Perspectives. My name is Rob Pizzichetta, founder of Mont Wealth. And in this episode, we're unpacking the key takeaways from our October Investment Committee meeting and expanding on them with what's unfolding since, including some fresh data from the RBA, the US labour market, and gold and bond markets. And as always, everything we discuss is general advice only. Anyone acting on this information without written and agreed consent does so entirely at their own risk. If you enjoy our discussions, please subscribe and share. It helps us keep producing these insights. And we are working on some very exciting guests, so it helps bring new names and guests to talk to and learn from. As I said, general advice disclaimer, there it is to those looking at the YouTube, and I've discussed and highlighted. Now, our investment committee remains the same. Myself as the chair, Bess Lataska and Jay Kumar, who contributed to this meeting. So we'll share some of those summaries now. So looking first at the performance for September, our strategic growth portfolio delivered 1.1% for the month, outperforming our benchmark and ahead of what we're trying to achieve as 8% total return for the year net of fees. And when we look at the contributions for the month, alternatives were the largest driver, given gold was such a large lift for the month. Obviously, property did well as well. Infrastructure outperformed. Our Aussie equities managers unfortunately underperformed, delivering negative returns, but actually outperformed their benchmarks. On the fixed income side and international fixed income side, free managers outperformed the market. And our global equities managers actually underperformed slightly, but still delivered positive returns. And for the month, the attribution alternatives was 0.5% of that 1.1%. Global equities was 0.4%. And infrastructure, Australian fixed income, and international fixed income was 0.1% each. As we move forward to the income portfolio, it delivered 0.5% for the month of September, slightly below its target of the RBA cash rate plus 3%, but over the 3, 6, and 12 months, it's well and truly exceeded expectations and the objective of the fund. Remember, it's RBA cash plus 3%. And if we talk to some of the contributors for the month, property and infrastructure, so real assets, delivered really strong returns for the month. Again, Australian fixed income and international fixed income delivered positive returns and outperformed their benchmarks. Aussie equities was the drag, as well as global equities, both falling 0.8 and 0.4% for the month. When we look at the key attribution for the month, infrastructure, alternatives, property, international fixed income, and Australian fixed income was what helped drive that 0.5% return for the month. Now, as we move forward, let's set the scene. As we all know, global equity markets remain near record highs. The S&P 500 has now rallied more than 80% from its 2022 lows, and the AI-driven growth story continues to dominate the narrative. Yet underneath, we're seeing signs of fatigue. Valuations are stretched, participation is narrow, and a few dominant sectors, which include semiconductors, cloud, and large cap tech, are doing most of the heavy lifting. In Australia, the ASX 200 lagged but remains resilient, supported by dividend yields, energy, and a switch from the banks to resources exposure. However, volatility has started creeping back into the picture as investors debate whether we're at the tail end of a Goldilocks environment or the start of something more unstable. Now, when we talk about the global scenarios, we set the scene. Now, currently our base case is for a softish landing and gentle cuts. This is where CPI drifts down, labour softens without spiking unemployment, the RBA and Fed execute cautious cuts, and the 10-year yield drifts lower. Bonds outperform cash, equities grind with rotations, and gold consolidates. So we maintain duration overweight, equities neutral with value bias, infrastructure overweight, and gold neutral at target. Now, there are two separate scenarios that could play out. Upside, where AI productivity surprises, and this will push growth assets even further. Earnings breadth improves beyond tech, real income lifts consumption, and equities broaden, yields fall, but curve steepens on growth optimism. Now, the downside, if we start to see cracks in the credit and policy shock. Now, we saw some signs from the US regional banks, some stress on high yield, and this could cause an accident, and also if tariffs bite. So we've actually increased our downside risk from 25% to 30%. We could also see a rapid safe haven bid, which yields lurch lower, and US dollar firms and gold spikes. So we'd add sovereign duration on stress, we'd trim our cyclical bets, and let the gold hedge do its job and keep some powder dry. In this case, we would want to be increasing our cash position as well. Also, as we look forward at our October meeting, we discussed and highlighted that both the RBA and the Federal Reserve are now likely steering toward a neutral rate environment. How quickly we get there is the million-dollar question, but we're starting to see recent data confirm that view. The RBA has held the cash rate steady at 3.6%, signaling patience as it balances sticky inflation against softening growth. Inflation remains above target, particularly in services and new dwellings, but the labour market is loosening and household consumption is starting to recover modestly from the 2024 slowdown. In the US, the picture is similar but more dramatic. The Fed is navigating what our friends at the Yield Report described as a fragile equilibrium, where both labour demand and supply are weakening simultaneously. Non-farm payrolls in August grew by just 22,000 jobs, well below expectations, yet unemployment has barely moved because participation is also falling. That tells us the economy is cooling, but not collapsing. Markets are pricing up to 5 US rate cuts through 2026. Long duration yields have already rolled over, with the US 10-year drifting back below 4%, while in Australia, 10-year yields have retraced towards 4.1. Bond markets are clearly speaking. The next big move is lower rates. So in Australia, the dilemma is this. We're focused on the October 29 CPI print. A reading near 2.7 for CPI for the quarter could be the trigger for a Melbourne Cup Day rate cut, something markets now see as more likely than not. Unemployment has risen to 4.5%, the highest in 4 years, and participation is ticking lower. Wage growth remains benign, and fiscal support from stage 3 tax cuts is starting to lift disposable incomes, but there is nuance. The RBA minutes noted that while inflation is easing, services components remain sticky, particularly utilities, insurance, and education. That means an early rate cut will likely be cautious, maybe one on Cup Day perhaps, and another mid-2026 as they guide the economy gently back to neutral, around 3%, but all eyes are on the 29th of October. When it comes to bonds, the repricing has begun. We talk a little bit about already that the 10-year yield has come back from 4.4-ish to 4 and 4.1 for the Aussie market. But one of the key discussion points was moving from floating rates to fixed rate exposure. But what does this actually mean? Own more government bonds versus corporate bonds that benefit when rates are cut. This opportunity sits in the belly of the 5 to 7 year term and 10-year term as well for government bonds. A lot of the short end of the curve is already priced in rate cuts, so less opportunity there as we push out a little bit in towards the belly and the longer end. The rationale is simple. Yields are still attractive, inflation expectations are moderating, and we're on the cusp of an easing cycle. Since September, global bond yields has fallen 40 to 50 basis points, and as I highlighted earlier, around 4 for the US 10-year and 4.1 for Australia at the moment. Now, credit spreads, on the other hand, are razor thin, meaning investors are barely being compensated for taking any corporate credit risk. That's why we're considering tilting portfolios back towards government bonds over high yield. This reallocation aligns with our 5-step investment process, beginning with clear objectives through asset allocation and fund selection to implementation and ongoing monitoring. Our goal remains the same, 8% per annum return through the cycle for strategic growth and RBA cash plus 3% for income portfolios net of fees. Obviously, there's been plenty of discussion recently around gold and how it's rallied hard. It has surged past 4,300 per ounce US dollars, and it's come back a little bit of the way, but it has delivered 50% year-to-date returns roughly. Before this week, it had 9 straight up weeks in a row, but we've seen more recent volatility, which is expected as assets never rise in straight lines. It's an extraordinary move for what's typically considered a steady asset, but as we discussed in the IC meeting, the parabolic rise is reason for caution. Demand from global central banks, particularly in emerging markets, are buying at record pace. Countries like China and Poland added more than 90 tons in 2024 alone, and diversifying away from the US dollar and insulating reserves from geopolitical risk. For the first time in decades, global official gold holdings now exceed foreign holdings of US treasuries, a symbolic moment that underscores a slow but powerful de-dollarization trend. In short, gold has become the centerpiece of new global reserve strategy, such as the hedge against inflation, it's a statement against debt and currency debasement, and hence why we are also doing some work on digital assets. Still, with prices at record levels, we've moved our tactical position from overweight to neutral. The long-term case remains strong, but the short-term froth warrants prudence. We have an allocation of around 3% to gold in our strategic growth portfolio, and that will remain the same. Now we move on to the US labour market, something that's really concerning the Federal Reserve members. According to the yield report October analysis, the US is now in what they call a three-low equilibrium: low hiring, low layoffs, and low labour force growth. Firms are freezing headcount rather than cutting jobs, maintaining productivity while reducing costs. This has been made possible by the rapid adoption of AI and automation, which is boosting output without increasing labour demand. The August payroll report, just 22,000 new jobs, confirmed the cooling trend, yet unemployment hasn't spiked yet because both supply and demand are slowing in tandem. The Fed recognises this fragile balance. It's likely to ease policy not to stimulate growth, but to stabilise employment and avoid a deeper slowdown. In other words, monetary easing now is less about reigniting inflation and more about protecting the labour market's delicate equilibrium. AI remains a defining macro theme of this cycle. From an investment standpoint, it's both a growth catalyst and a valuation risk. Unlike the short-lived tech booms of the past, this AI cycle is structural, expected to last 10 to 20 years, driven by enterprise adoption, sovereign computing demand, and infrastructure investment. AI spending now cuts across industries, defense, utilities, healthcare, and manufacturing. It's reshaping productivity growth and tax revenue potential in ways reminiscent of past industrial revolutions. But as I mentioned in the IC meeting, there's also a circular reference here. AI companies, hardware suppliers, and governments are simultaneously funding each other, which inflates earnings in the short term. As long as capital keeps flowing, the music continues. But once investors start demanding a return on investment, we may see consolidation. For now, it remains a key driver of corporate profitability and market optimism heading into 2026. The upcoming results in the US will determine the direction of US markets. Long AI is an overcrowded space. They can't afford to disappoint yet. So when we talk about the cross currents of tariffs, shutdowns, and fiscal stress, one of the dominant global stories this quarter has been the emergence of trade tension. Trump's administration reinstated 100% tariffs on certain Chinese imports, targeting rare earths and strategic software. Hence, makes sense why the US is trying to do a deal with Australia and its rare earths. China retaliated with export restrictions on critical minerals, a clear signal that geopolitical risk remains embedded in the global economy. Now, this trade war narrative has coincided with US government shutdown, now stretching beyond 30 days, the longest in recent memory. Federal employment data have been delayed, adding to the data vacuum the Fed is grappling with. Historically, shutdowns have had minor GDP effects, but this one's different. It includes permanent job cuts and structural budget tightening. That adds fiscal drag even as the Fed turns dovish. Globally, fiscal dynamics are diverging. The UK, Germany, and Japan are all loosening budgets while the US faces deficits north of 6% of GDP. That combination, expansive fiscal policy and easy monetary policy, is creating fertile ground for gold and government bonds to perform simultaneously, a rare pairing we haven't seen since the early 2000s. So we talk about portfolio positioning. As you can see for those on the screen at the moment, the directional views from our support from Foresight Analytics and Jay Kumar's team. The current view is cash, slightly underweight given the lower expected returns as rates decline. Bonds, slightly overweight with an emphasis on quality duration in both Australia and the US. Equities remain neutral, but with a bias toward value and quality earnings rather than high multiple growth. Real assets, overweight, particularly infrastructure with inflation-linked income streams. And alternatives, overweight, focusing on defensive yield and liquidity, including gold. And as I mentioned earlier, we're doing some work on digital assets and crypto and private credit. Now, within Mont Wealth's portfolios, we continue to use active tilting, adjusting exposures around a strategic asset allocation to macro signals. Our strategic growth portfolio remains roughly 60-40, which is growth defensive, while income sits closer to 50-50. So how are we positioned and why? As I said, with cash, we're not hiding, just neutral, slightly underweight. You'll notice that cash dollar is centered. We've already seen that some term deposits and cash accounts have dropped. If CPI behaves, the opportunity cost of sitting in cash rises. We still like cash for liquidity and option value, but we're redeploying a slice of the duration and resilient income where the risk-adjusted payoff looks better. On equities, as we noted, slightly neutral, selective under the hood. The equity dial sits neutral even as indices flirt with highs. We still respect earnings resilience. The street has been reviving up for financials and select cyclicals, but we prefer quality cash flows and valuation discipline, tilting to value as a shock absorber should AI lead growth wobble. Under the bonnet, we're also mindful of services inflation stickiness in multiple economies, which can crimp margins if price power fades. So neutral overall, but more value quality, less momentum beta. We favour quality earnings, dividend growers, and boring compounders. Keep growth exposures, but demand free cash flow discipline. Hence why we recommend active managers to identify these opportunities. As noted, bonds, we're shifting our exposure slightly higher. We're doing some work and waiting for that decision or report on CPI on the 29th. This is where there is clear conviction and then an opportunity to generate wealth and also alpha. Long yields have rolled over, but there's an opportunity for them to continue to do so. Meanwhile, credit spreads, as noted earlier, remain very thin, leaving little compensation for lower quality risk. On the real assets front, infrastructure stays in our good books with inflation-linked policy-backed cash flows. But given the performance over the last 12-24 months, the team at Foresight decided to move from a double overweight to a single overweight position. We remained with a 10% allocation to both the income and growth portfolios, but these businesses and allocations are in good tact. The regulated assets, long concessions, and visibility of distribution. Real estate is more mixed. Funding costs are still biting and rent growth has cooled, so we're neutral to underweight there. But in saying that, as interest rates come down, real assets, including real estate, should benefit. And alternatives, we recently attended a private asset conference, and there's a lot of demand for private credit and private equity at the moment, and we remain overweight on the defensive side, which is private credit. Think low beta, income-oriented strategies. And at the moment, as long as the RBA is not too aggressive on cutting rates, we continue to see at least 7 to 9% income distribution from our quality private credit managers. On gold, we've discussed that already. There's a structural growth story, central bank accumulation. We believe that the 3% allocation makes sense. As I said also earlier, as the gold price continues to rally hard, it's not expected to go up in a straight line. Expect further volatility. That's all about asset allocation strategies. So stepping back, it's clear we're living through a regime change in capital markets. The old drivers, which were globalization, cheap debt, disinflation, have given way to new forces, reshoring, government deficits, higher interest costs, and sustained inflation. This means future returns are likely to be lower and lumpier than the past 2 decades. But it also means active management and diversification matter more than ever. The role of private assets, infrastructure, and income strategies, the very tools we discussed at the recent Wealth Leaders Exchange, will be critical in building resilient portfolios. So looking forward, as we move into year-end and early 2026, 3 watch points stand out. 1, inflation trajectory. If CPI undershoots expectations in both the US and Australia, the first half of 2026 could see synchronized rate cuts, a tailwind for bonds and growth assets alike. 2, labour market resilience. Watch whether the 3 low equilibrium holds. If layoffs rise meaningfully, the Fed could accelerate its easing path. Remember, they've got at least 5 or 6 rate cuts even before they get to neutral, so they've got ammunition available to them. And then finally, geopolitical risk and fiscal policy. Tariffs, shutdowns, and deficits remain the biggest macro wildcards. Fiscal credibility or lack thereof will determine whether this rally has further to run. So, looking forward, patience, perspective, and positioning. To summarize, we're entering a world of lower rates, slower growth, and high volatility. But that doesn't mean opportunity disappears, it just shifts. Bonds are offering yield and upside for the first time in years, and equities, though expensive in places, still benefit from earnings resilience and AI-driven productivity. Thanks for tuning in to Perspectives. My name is Rob Pizzichetta, founder of Mont Wealth. If you found today's episode valuable, please subscribe and share. And remember, this is general advice only. Thanks for listening.